Welcome to Woods of Stardon. This is CH. I will be covering the series of Dimensional World Allocation Funds in this video, which is part of my Absolutely Biased Comments or ABCs series. There are 4 funds in this series with different asset allocation mixes but are otherwise similar. The aim of this series is to cover one fund per video to share how an individual investor can try to find out more about a fund from public sources and do some basic research or simple due diligence on the fund before deciding to buy the fund or walk away. Some quick disclaimers before we start. This is not a product sales pitch or a recommendation to buy. I'm not sponsored by anyone to do this video. Please do your own research and be clear about the product features and risks before taking any action. The Dimensional World Allocation Fund series are also building block products as well as risk profile benchmarks used in Das Family Office, where I worked at. Do visit our website at dfo.sg if you would like to find out more. Dimensional Fund Advisors is a US-based quantitative investment solutions provider founded in 1981 by David Booth, Rex Sinfield, and Larry Klotz. David is currently the only co-founder remaining in the firm, and he is also the chairman. Dimensional is best known for its exceptional team of financial academics that provide the scientific and systematic investment process behind its products. Of most notable mentions are several Nobel winners, including Eugene Fama, whom David and Rex studied under in the University of Chicago Graduate School of Business, Robert Merton, who was a founding independent director and now resident scientist in the firm, Douglas Diamond, who is an independent director, Myron Scholes, who was a founding independent director until 2021, and also the late Merton Miller, who was also a founding independent director. Dimensional today remains a privately owned business that manages over $960 billion of assets and has over 1,600 employees in 15 global offices. Product offerings include ETFs, mutual funds, and various types of managed accounts. Dimensional firmly believes their investment approach, of which factor investing is one of the key aspects, can generate more consistent outperformance over time, and they have a good track record to showcase this. Dimensional categorizes its products into 4 series that are market, core, component, and multi-asset. The Dimensional World Allocation Fund series that is covered in this video falls without surprise under the multi-asset series. The Dimensional World Allocation Fund series are 4 sub-funds under the Dimensional Fund plc fund family. The fund family is set up as an Irish investment company with variable capital or ICVC structure and is UCITS qualified. The 4 funds are registered as MAS recognized schemes, which means they are suitable for retail investors. Dimensional runs all its funds through its massive systematic models in a unified process approach, and therefore doesn't really identify any specific manager names for its funds. Morningstar does indicate Nathan Lacasse as the manager of the Dimensional World Allocation Fund series, probably because Nathan is the co-CEO of Dimensional UK and also the chair of the board of directors of Dimensional Ireland, that is the business entity responsible for the Irish domiciled funds. The Dimensional World Allocation Fund series has 4 funds, each with a predefined asset allocation mix that is stated in the fund name. The World Allocation 2080 Fund, for example, is supposed to have about 20% equity exposure and 80% fixed income exposure, and so on. The investment objectives of the 4 funds are completely identical, that is simply to achieve long-term total return. There is no mention of income, so we know that the funds are not designed to prioritize provision of income to investors. It is also mentioned that the funds invest in other funds besides stocks and bonds, and by assumption, these would be other dimensional funds where relevant. I do want to mention here that I strangely cannot find any fun fact sheets in the Dimensional Singapore website. I hope Dimensional can fix this soon. The prospectus, on the other hand, is readily available and provides a pretty lengthy investment policies section for each fund that are also near identical save for the parts on asset allocation guidelines. As such, I will be using the extract for the World Allocation 2080 fund here and point out the differences with respect to the other funds. The funds are essentially multi-asset funds that focus on fixed income and equity exposures only, so there should be no direct commodities or real assets exposures, for example through ETFs or other funds. It is clearly mentioned here that the equity exposures include global developed and emerging market countries, but fixed income exposures include only global developed countries. The funds are allowed to invest up to 100% of assets into other funds or collective investment schemes as long as they comply with these investment policies. The next paragraph provides the asset allocation guidance for the funds. The first number in the fund name refers to the target percentage equity allocation, while the second number in the fund name refers to the target percentage fixed income allocation. There is an allowance of plus 20% to minus 20% deviation allowed from the targets. For example, the World Allocation 2080 fund has a target allocation of 20% equities and 80% fixed income, with the flexibility of 0% to 40% equities and 60% to 100% fixed income. This flexibility allows the funds to overweight or underweight the asset classes in different market conditions in attempt to generate alpha returns on top of the target allocation model. The prospectus then goes into details on the types of fixed income the funds can invest in, that include government, quasi-government, and corporate bonds, as well as money market instruments from developed countries. It is specifically mentioned that the funds will only invest in investment-grade rated bonds. Guidelines for bond maturities are also mentioned, whereby inflation-linked bonds should be less than 20 years maturity and all other bonds should have about 5 years of maturity upon investing. From these guidelines, it looks quite clear that the funds steer away from higher risk bonds in terms of both credit rating and geographical exposures. Next are the details on the types of equities the funds invest in. Dimensional is well known to have a preference for smaller market cap companies and also value stocks that are elaborated here. Market cap categorization is defined differently for each country. Value stocks, as per Dimensional's definition, are those with high book value in relation to market value, but also have other factors considered such as price to cash flow or price to earnings ratios. There may be also other biases such as profitability and momentum that can change in different market conditions. While the funds have these biases in the investment strategy, we will see later that the overall portfolio is still highly diversified. While it was mentioned earlier that the funds can invest up to 100% into other funds or collective investment schemes to achieve the desired fixed income and equity exposures, there is a constraint defined here to limit a max 20% in any one collective investment scheme. The funds can also invest in depository receipts, for example China ADRs listed on US markets. For currency exposures, the funds adopt a different approach for equity versus fixed income. Equity exposures are generally left unhedged in terms of currency exposures, which is the norm for most equity mutual funds in the market. The currency exposures of the equity positions would typically be factored into the returns expectations. Fixed income positions, on the other hand, are typically hedged into the base currency of the fund, that is US dollars. Again, this is also the norm for most fixed income mutual funds in the market, unless it is a local currency bond strategy. Besides currency hedging, the funds do not intend to use any derivative instruments. So we will not find, for example, equity option strategies as a returns attributor. That's all there is in the prospectus actually, which doesn't really cover the investment process, so we will need to find more information elsewhere. To better understand the concepts behind the World Allocation Funds, I'll refer to an article Dimensional published specifically on this. Strangely, I can't locate this article and other research materials in the Dimensional Singapore website, so I have to go to the Irish website instead. The Dimensional World Allocation Funds are created to address different investor risk profiles. They utilize Dimensional's systematic models to optimize asset allocation mix from the high-level equity versus fixed income to countries and regions and individual securities. Very importantly, the portfolios are reviewed and rebalanced on a daily basis, which is only made possible through the systematic models. Many multi-asset funds and ETFs in the market adopt a fixed periodic rebalancing, for example, quarterly or semi-annually, which is less optimal and is subject to allocation drift in between the rebalancing periods. Dimensional is well known for its equity research and investing capabilities that stem from long periods of academic findings. Its model emphasizes on obtaining higher returns through smaller market cap, value bias, and high profitability as the three main components in the stock selection and portfolio construction processes. This is directly evidenced in the actual portfolio of the funds. Using the Dimensional World Equity Fund as a proxy for the equity exposure in the World Allocation Funds, we can see notable differences in its portfolio exposures to market cap, growth versus value, and as well profitability compared to the MSCI All Country World IMI Index. The fixed income components in the World Allocation Funds are designed with different considerations. The example in the article compares the 2080 fund with the 60/40 fund. The more conservative 2080 fund has a higher priority on capital preservation, and therefore the fixed income exposures are tilted towards higher credit rating and lower duration. The 60/40 fund, on the other hand, is intended to produce more capital appreciation, and therefore the fixed income exposures have more single A and triple B rated bond exposures with more duration allowance. This picture nicely summarizes the three equity factors and three fixed income factors used in the World Allocation Funds. Dimensional actually has quite an amount of relevant resources available, but scattered across different country websites, and would take too much time to cover in this video. Suffice to say, there is a pretty mature and sophisticated systematic model that is supported by detailed academic research behind the funds. As investors, it is more important to see how this translates to the actual portfolios and the eventual performances we get, which we will be going through next. The Dimensional World Allocation 40/60 and 60/40 funds were incepted in 2011, while the 2080 and 80/20 funds were incepted in 2015. This gives all the funds more than 10 years of track record, although not all currency share classes are available since the fund inception dates. From the AUM of the funds, we can see which asset allocation mixes are more popular. The 60 equities 40 bonds allocation has significantly more AUM than the others at $7.3 billion, suggesting this is the most common asset allocation mix global investors would go for in a multi-asset fund solution. The 80/20 fund is next at $4.1 billion, suggesting equity-focused investors are more willing to try out a multi-asset fund with a small allocation in fixed income for some risk diversification. The fixed income focused allocation mixes have notably lower AUM, with the 2080 fund at only $360 million, suggesting risk-averse or fixed income focused investors may prefer sticking with the pure fixed income solutions instead, or simply shy away from multi-asset solutions. On a high-level asset allocation breakdown, we can see the four funds are keeping very close to their respective target allocation mixes. Developed and emerging equity are separated, with emerging equity about 12% of the equity exposure in the portfolios, which is slightly higher than the 8% in MSCI All Country World Investable Market Index or ACWI IMI. Dimensional also clearly indicates any underlying funds and ETFs within the world allocation portfolios. Many of the underlying funds and ETFs are the same across the 4 world allocation portfolios with different allocation percentage. But we can also see some differences across the funds. For example, here we can see the 2080 fund has some allocations to direct fixed income that should be the most optimal outcome, but may be difficult to deploy to other funds due to liquidity and size constraints in the bond market, as well as the smaller allocations to fixed income in the other funds. In contrast, the 2080 fund uses mainly the World Equity Fund as an underlying position to express its limited equity positions, while the 4060 fund has a bigger allocation and therefore can allocate to more underlying equity funds and ETFs to be more precise in getting the exposures defined by the model. The reverse is seen in the 8020 fund, whereby only 2 underlying fixed income funds are used. What is interesting here is that while the 8020 fund uses a long list of different underlying equity funds and ETFs to express its exposures more precisely, the 6040 fund has taken a completely different approach by investing completely in direct equity positions. I wonder if this is because the 6040 fund has a much bigger AUM than the others, and therefore allows it to invest only in direct equities to achieve the best precision according to its model. If this is the case, then as the 4 funds grow in AUM, we should see their portfolios eventually all switch to just direct equities and direct fixed income exposures. One reason why the fund needs to have a large enough AUM before switching from funds and ETFs to direct securities in the portfolio is because Dimensional's systematic models produce portfolios with a large number of holdings. Here, we can see on a see-through basis, the 2080 fund has about 14,000 equity holdings and 1,300 fixed income holdings, while the 4060 fund has about 16,000 equity holdings and 1,900 fixed income holdings. It would be difficult for a fund to invest directly in these amounts of positions unless the fund AUM is large enough. The differences in these numbers are a result of the different allocations of the underlying funds and ETFs in their respective portfolios. But importantly, we can see that the equity and fixed income characteristics are similar, which is what the model wants to achieve. For the 6040 and 8020 funds, we still see similar equity characteristics, but fixed income characteristics look slightly more aggressive with longer weighted average maturity and weighted average effective duration, showing the model tweaks the exposures to get higher yield to maturity for the more aggressive portfolios. It is also interesting to note that the 6040 fund that holds only direct equities actually has the least number of equity positions. From these numbers across the 4 funds, I would estimate the model can be fully optimized with about 12,000 direct equity positions and about 1,200 direct fixed income positions. Let's go through the equity exposures first. Here is a sector breakdown, and we can see there is not much difference comparing the 2080 fund and the 8020 fund, suggesting the same model results are used across the 4 funds. Comparing with the SPDR MSCI All Country World Investable Market UCITS ETF, we can try to see the differences in the dimensional model versus the broad equity market index. The fund has slightly less technology, communication services, and real estate, in exchange for more industrials, consumers, materials, and energy. This points to a slight value bias as expected of Dimensional's model, although the biases are actually not that significant. Country breakdown are also similar across the 4 funds, again suggesting the same model results are used. Comparing again with the SPDR MSCI All Country World Investable Market UCITS ETF, we can see the country exposures are highly similar. So it seems the model behind the funds does not take active views to overweight or underweight at country level. There is no market cap breakdown, but we can get a rough sense from the average market cap in the funds. Here, we can see the world allocation funds have a slightly lower average market cap compared to the SPDR MSCI All Country World Investable Market UCITS ETF, showing a slight bias towards small caps. The funds also have more than double the number of holdings compared to the ETF, whereby the bulk of these additional holdings have to be small and micro-cap stocks that are not covered in the MSCI index. The lower price-to-book ratio in the funds also suggests a bias towards value-style stocks and is also a result of the sector tilts. The only factor I can't compare here is profitability, whereby the statistics are not available in the SPDR MSCI All Country World Investable Market UCITS ETF. Top 10 equity holdings is provided. While the names look similar to the SPDR MSCI All Country World Investable Market UCITS ETF, since there are no significant differences in the exposures, there seems to be some guidelines to reduce single position concentration risk. We can see, for example, the top 2 holdings in the funds that are Nvidia and Microsoft having less than 3% weights, while they are over 4% in the ETF. Let's go through the fixed income exposures next. As mentioned earlier, fixed income positioning in the 4 funds tend to be quite different and reflects the risks and returns that comes along with the respective asset allocation mixes of each fund. Here we have the 2080 fund versus the 8020 fund, where we saw earlier that the more conservative 2080 fund has much lower average maturity and average effective duration, resulting in a slightly lower yield to maturity. This is also seen in the portfolio breakdown data. The 2080 fund holds more government and government-related bonds that are all less than 5 years maturity, and the portfolio is mostly in the highest credit ratings of AA and AAA. The 8020 fund, on the other hand, has much more corporate bonds, with the portfolio having about 40% in bond maturities of 5 years and longer, as well as more exposures in single A and BBB instead. Top 10 fixed income holdings are also provided. There are mostly government and government-related bonds that can be scaled up as needed. While there is no country breakdown data available for the fixed income exposures, we can see from these top 10 holdings that there seems to be pretty decent country diversification. The prospectus did state that fixed income in the funds are all developed market exposures and investment-grade credit rating only. So the model behind the funds will not be taking excessive risks in terms of fixed income positions. While the prospectus does not indicate any benchmarks for the world allocation funds, the fund web pages do state comparative indices for the purpose of performance comparison, which we will go through later. Interestingly, the comparative indices are MSCI All Country World Index and FTSE World Government Bond Index 1 to 5 years, in the same currency exposures as the share classes. So the Sing Dollar share classes, for example, will have the same comparative indices but hedged to Sing Dollars. The Dimensional World Allocation Funds do not come with a lot of share classes. Interestingly, they are designed more like ETFs with a common share class for all investor types, whereby the management fees are pretty low at just 0.26%. Adding other expenses gives a total expense ratio or TER of around 0.32%. This is a very competitive fee structure for an actively managed solution. As expected, Dimensional does not pay any trailer fees to distributors for these funds, again similar to ETFs. Distributors can, however, charge a subscription fee, and while there is no maximums specified in the prospectus, I think anything more than 2% for mutual funds is excessive. The funds offer a variety of currency share classes, and they are all currency hedge classes. As mentioned earlier, the currency hedging applies only to the fixed income portion of the fund portfolio, while the equity position are normally left unhedged. Most of the share classes available currently are accumulation classes, especially for US dollars and Sing dollar classes. The fund has no income generation objectives, and Dimensional historically has been focusing more on institutional investors that have little need for distribution share classes. As such, I have listed here only the accumulation US dollar and Sing dollar share classes for reference. The US dollar classes were launched in 2018, while the Sing dollar classes were launched a few years later. This means that if we use these share classes for performance comparisons later, we won't be able to run 10-year charts. The Dimensional World Allocation Funds provide calendar year returns as well as returns over various time periods in its fund web pages. Here is the returns over various time periods of the 4 funds together with the 2 comparative indices that are MSCI All Country World Index to represent equities and FTSE World Government Bond Index 1 to 5 years to represent fixed income. The US dollar share classes were all incepted in 2018, so the longest data period provided is 5-year annualized. Here is the calendar year returns data where we can try to do a bit more assessment. The good thing here is that since 2019, the markets have gone through a number of significant events, from COVID to post-COVID correction to sharp interest rate changes. And as such, we can see whether the funds behave well through these 7 years. Now, if we assume the comparative indices are investable, and that we try to do the same asset allocation mixes for each year, the table on the right is the resulting calendar year returns. Do bear in mind that the world allocation funds are rebalanced daily, and it is near impossible for a typical investor to do a daily rebalancing on an individual portfolio. Given equity markets have significantly higher magnitudes of returns compared to bond markets, the returns of the asset allocation mixes are mainly driven by the equity market conditions. On a relative basis, the world allocation funds performed better in 2021 when market conditions were uncertain, and 2022 when market conditions were bearish. In other years that were more bullish, however, the funds underperformed the asset allocation mix on the comparative indices that had no rebalancing. This is because when the equity markets move up strongly, the world allocation funds trim down the equity allocations daily as per its rebalancing process, and therefore did not manage to fully participate in the equity upside. The reverse is true for the bearish markets, and this does mean that the daily rebalancing process of the funds tend to work better in uncertain and bearish market conditions, which will attract risk-conscious investors more. Let's run some Morningstar performance comparison charts. For a start, here are the US dollar share classes of the 4 Dimensional World Allocation Funds since incepting in 2018. There are not that many fixed allocation multi-asset solutions outside of US. I think the biggest competitor for the Dimensional World Allocation Funds is probably the US-listed iShares Core ETF series that are AOK, AOM, AOR, and AOA. As seen in this chart, the iShares ETFs seem to have outperformed the dimensional funds by quite a gap for this almost 8 years time period. Moving to a shorter 1-year chart, we can see the dimensional funds have delivered much more similar returns as the iShares ETFs, although most of them are still trailing behind the iShares ETFs slightly. So how different are the iShares ETFs? In summary, they are passive trackers on the S&P Target Risk Index series. Besides the conservative index that have a 30% equity plus 70% fixed income mix, the rest are similar to the fixed allocations of the Dimensional World Allocation Funds. Given the iShares ETFs are passive index trackers, they are rebalanced semi-annually compared to the daily rebalancing of Dimensional funds. And as explained earlier, the rebalancing frequency can have very different effects in bearish versus bullish markets. The iShares ETFs also invest only in 7 specific iShares ETFs in their portfolios as listed here, whereas Dimensional funds can invest in other funds with no limitations and can invest in direct securities as well. The underlying equity ETFs in the iShares portfolios are allocated based on float-adjusted market cap weights. that actually results in a pretty similar overall equity exposure as that in the Dimensionals funds. The main difference would be that in Dimensionals funds, there are a lot more equity holdings, in particular small caps. And also, there is a slight value and profitability factor tilt. Fixed income, on the other hand, has more differences. iShares portfolios have the same fixed 85% allocation to the US dollar bond ETF and 15% allocation to the international bond ETF across all four ETFs. Dimensionals funds, as mentioned earlier, have more dynamic differences across the four funds. There is also a small high yield exposure in the iShares portfolios, although not significant. Despite stating these differences, it doesn't hide the fact that the iShares ETFs indeed have higher returns than the dimensional funds in the past 7+ years. So I think another key consideration for investors is the structure of these solutions. The iShares ETFs are US listed ETFs, and therefore are tradable in US dollars only and has periodic distribution payouts that are subject to US withholding tax. For investors who prefer a mutual fund structure or doesn't need distribution payouts or wants non-US dollar trading choices, the dimensional funds serve as a solution to address these requirements. Of course, it would be more ideal if Dimensional can further optimize its models to generate better returns for the world allocation funds. So what can investors use the Dimensional World Allocation Funds for? One clear usage is to use them as benchmarks to assess how good or bad other funds have performed. For example, in this one-year chart, we can see PIMCO Balanced Income and Growth Fund outperforming the World Allocation 80/20 Fund, even though PIMCO has a less aggressive high-level allocation, which suggests it has managed to achieve alpha returns through sub-asset class allocation and security selection decisions. Manulife Global Multi-Asset Diversified Income Fund, on the other hand, has about a 50/50 allocation, but has underperformed the World Allocation 40/60 Fund, suggesting the opposite of what PIMCO has done. Since the Dimensional World Allocation Funds have other currency share classes as well, this also makes comparison a lot easier for non-US dollar investors. For example, in this one-year chart, we compare the Sing dollar share classes of World Allocation Funds with some of the multi-asset funds offered in Singapore. Besides Lion Global All Seasons Growth Fund performing very similar to World Allocation 80/20 Fund, the others have actually delivered returns more similar to the World Allocation 40/60 Fund. Good if this is what you expected of these funds. Otherwise, this chart may allow you to rethink the choices again. More importantly, we can also compare against pure equity funds and pure bond funds, especially if you have invested in the higher fee retail share classes. For example, in this 5-year chart, we can see an income-focused global equity solution like the BlackRock Systematic Global Equity High Income Fund hasn't really done so well. Perhaps we can switch it to the Dimensional World Allocation 80/20 Fund that has a lower drawdown in 2022 and better return for this 5-year period. Another example is the PIMCO GIS Income Fund that has been a decent performer in US dollar terms, but not so great in retail Sing dollar terms. Perhaps we can switch it to the Dimensional World Allocation 20/80 Fund that has a better return and lower volatility track record. In short, the Dimensional World Allocation Funds improve the variety of choices to investors once you treat them beyond just multi-asset solutions. With that, let's summarize our findings. Dimensional Fund Advisors is a US-based investment firm best known for its star-studded academic team, of which several are reputable Nobel winners. It has a consistent academic-based systematic or quantitative approach across all its product offerings. The Dimensional World Allocation Fund series comprises of 4 fixed target allocation multi-asset solutions, with a mix of 20/80, 40/60, 60/40, and 80/20 mix of global equity versus global fixed income. The equities portfolio are consistent across the four funds in their respective proportions. Equities cover global, developed, and emerging markets, with slight biases in small caps, value style, and profitability factor that are the three key drivers in Dimensional's equity models. Given this is a systematic driven portfolio, there are a large number of holdings of more than 10,000, far exceeding most active mutual funds. The fixed income portfolio, on the other hand, cover only developed markets and only investment-grade rated government and corporate bonds. Fixed income exposures are also more dynamic and varies across the four funds, with higher credit rating and lower duration in the more conservative 2080 fund, and vice versa for the more aggressive funds. The fund prospectus unfortunately doesn't provide a summary on the investment process, and this information seems to be scattered throughout the website in different web pages and documents. It would be good if Dimensional can provide a single source of information that can more comprehensively explain the investment process of the World Allocation Fund series. The fact sheets are also strangely missing in the Singapore website as I am preparing this video. Hopefully Dimensional can get this fixed soon. Dimensional offers a very straightforward single category of share classes for these funds. There are mainly accumulation classes with very low cost that is comparable to passive ETFs. They also come with a variety of currency choices that are currency hedged, making it convenient for investors of different currency requirements. The systematic model approach plus probably efficient trading allows the funds to be rebalanced daily to their target allocations, although this is both a good and bad thing. The bad is that during a bullish market, daily rebalancing reduces the exposures that continues to have better upside, thus resulting in the fund lagging behind a non-rebalance approach. The good is that the reverse is true in a bearish market, and therefore the funds tend to have a better performance in a weak or bearish market while lagging behind slightly in a bullish market. Daily rebalancing also obviously minimizes style drift and allocation drift for investors who have such concerns. As such, it would be good if Dimensional can improve its model to better capture market upside so that overall performance of the funds can get better. In conclusion, the Dimensional World Allocation Fund series are decently useful fixed target allocation solutions, in particular with the availability of a variety of currency share classes for different investor requirements. They can readily be used as performance benchmarks for quick comparisons, or even alternative product replacement ideas for pure equities, pure bonds, or multi-asset exposures. It would be optimal if Dimensional can further improve the performance of the funds. This concludes my absolutely biased comments on the series of Dimensional World Allocation Funds, and I hope it will help in your investment journey. May we all grow wiser and prosper.